talking the state of mining this Thursday with Eric Coffin, editor of Rock Advisories. Eric, good to have you back on the show.
Thanks for having me again, Daniela.
Well, let's start with your take on the mining sector right now. In your last newsletter, you noted that you were still on the fence about the market's major direction. You noted that you think that the odds of a drop of bear market proportions is very high right now. How fast could that happen, Eric?
There's two or three ways it could play out. What I'm seeing right now is the market came back to the August lows. I'm talking the major markets here. They've had a bounce. I don't think we're out of the woods yet. I think the S&P would have to get back above 2,000 for me to actually relax to any great extent. One danger I see sort of dead ahead is we're just about to start Q3 earnings season. I'd like to think that traders realize that we're probably going to have a sequential drop in earnings, but I'm none too sure that they do. I suspect that's not going to go over very well. It's not that things are doing terribly. It's just you've got a fairly richly valued market, and you start delivering 2 quarters in a row of earnings declines. I think the odds for something to go wrong are actually pretty high.
Well, Eric, let's talk about Glencore. Company officials met with fund managers in London this week to reassure investors that it is solvent. But experts are warning of the dire financial impact if Glencore, one of the world's largest resource companies, is unable to control its skyrocketing debt load. Could it be the Lehman Brothers of mining?
It's possible. You know, the thing with markets is when you get these long bear markets, and certainly mining's had one, traders start looking for, the old story is they don't ring a bell at the bottom, but the truth of the matter is traders are actually looking for a bell, and it may be in this case that the bell is Glencore or, pick 10 or 15 other companies either get into serious financial trouble and cut production back, or you simply see a bunch of miners in short order stop producing at a number of mines. I mean, I increasingly get the sense that's kind of what traders want to see. They want to see some supply side adjustment. Glencore could be it. I mean, the problem with Glencore is the biggest, most profitable part of the business, really, as huge as it is really their trading platform, and it's basically a black box. Nobody has a clue what the inside of that thing looks like.
Well, Eric, how hard does it get if the price of copper falls below $2 here?
It gets tough. I mean, it would be great medium term. It would be terrible short term. I think you'd see the production pipeline would basically vaporize. There's very few things that would get built. And although it wouldn't happen right away, I think you'd see the large miners, the large copper miners, very quickly start doing at least partial production cuts. The copper guys are better than most. I've been bearish on copper, some slightly bearish for probably a year and a half, but ironically, I think copper may be one of the first to really turn because the copper miners historically have been probably the smartest group when it comes to cutting production when they had to. And below $2, a lot of them would have to.
Well, Eric, you mentioned it. It's a tough environment, but are there some stocks you're liking these days? Who would you pick?
Well, just to add to the irony, one of the companies I'm following and have for a while and still like a lot is Nevsun. It's a copper producer, but it's got extremely low cash costs. They make a lot of money. They have sort of been on the acquisition trail for years now, but they've never really pulled the trigger. And what's happened during that period is they built up a huge cash balance. Nevsun trades at about $3.80 in Toronto right now. They've got something in the order of $3 plus in working capital per share. They've got about a 5% dividend yield, and they make a lot of money. Even like at $2 copper, they would still make a lot of money because their cash costs are low. So I view that one, if you need to own a base metal miner, I think that's a pretty low risk way to go.
Any other picks from you, Eric?
One other one I'll just mention on the gold side because I thought it was interesting. We saw another large placement, $22.5 million, done by Kaminak. Kaminak's one of those strong projects, strong management groups. They've got a high-grade open pit, heap leachable deposit in the Yukon. They're working their way through feasibility right now. It interested me because the biggest placee in that was the sort of the new Electrum fund, the Electrum company, and that's Kaplan, who's sort of been out of the market for several years, as far as I know. He raised about 250 million US this summer in an IPO for this new deal, and I was quite happy to see him buying into a strong development story rather than sort of being one of these vulture investors that was just looking for sort of the dead and wounded on the roadside to sit on for 3 or 4 years. To turn this thing around, we need guys that are willing to put money into strong deals, not just guys that are going to try to warehouse weak projects that might be good if metal prices go up 30%. That doesn't really get us anywhere.
Well, Eric, thanks so much for joining us today.
Thank you, Danielle.
And thanks for watching this edition of the Mining Report. We'll see you tomorrow. Thanks for watching.